a guide for beginners in commodity investing. How do you do it? As a beginner investor, you most likely began with stocks. With a little more experience under your belt, you might want to consider expanding and diversifying your portfolio. A broad portfolio has been demonstrated to be the greatest approach to avoid risk and maximize earnings as an investor. After all, diversifying your investments protect you from market fluctuations. Commodities investing can be a good method to diversify your investments transcending traditional securities, which is becoming extremely important in today's society. But as a novice investor, it's important to understand what commodities are. Commodities refer to any uniform resources that are regarded as essential goods. Everything from the grains in your breakfast cereal to the silver and copper in the crude oil that is processed into the gasoline you use to fuel your car is made from minerals. Commodities might be many things, but they all have one thing in common. They are physical and traded on global marketplaces. Because of variations in supply and demand, commodity prices are frequently volatile. For example, when a crop has a huge harvest, the price normally drops. Yet when there is a drought, prices typically rise due to concerns about supply. Metal, energy, cattle, and meat are the four main kinds of commodities that are traded. Each one has its own set of benefits and drawbacks, so deciding which to invest in comes down to your eventual priorities. If you don't know what you're doing, commodities may be a risky game, and it'll be far more advantageous in the long run to learn the basics first. There are various ways to invest in commodities, each with its own set of advantages and risks. So, here are 6 different approaches to commodity trading. Number 1. Directly invest in the commodity. There is no other way to get into commodity trading but to invest directly in one. One advantage of investing by physically purchasing a commodity is that you do not have to go through a third party. You can just look for a dealer to sell you a certain product, and that dealer will typically buy it back when you no longer desire it. However, you must arrange for delivery and storage. Furthermore, purchasing gold may be a rather easy procedure. You may easily locate a coin trader online who will sell you a bar or coin that you can safely store and sell later. However, figuring out the storage and handling of cattle, crude oil, or bushels of corn is significantly more difficult, which is why most physical commodities require too much work for individual investors. 2. Invest in commodity exchange-traded funds, or ETFs. If you know how to invest in stocks but just have a limited amount of money to invest, ETFs are a good way to go. Exchange-traded funds, or ETFs, allow you to trade commodities in the same way that stocks and shares are exchanged. They can be purchased and sold in the same way that stocks can, with prices fluctuating throughout the day. Those looking to buy commodity exchange-traded funds can do so through an online or traditional broker. ETFs are an excellent choice for those who want to profit from shifting commodity prices without having to invest directly in futures contracts. Trading ETFs is also a great way to get awareness of the commodities market with less risk because you can keep your ETF shares for as long as you choose and they don't expire after a set period of time. However, you should be aware of some of the fees associated with trading ETFs, or simply ask your broker if they could provide a demo ETF trading before investing. Number 3. Invest in futures contracts. A futures contract is another option to enter into commodities trading. A futures contract is a legally binding agreement to buy or sell a specific commodity at a preset price at a future date. Starting with futures contracts require extensive industry research and is often not suggested for novice investors. The reason for this is that majority of futures investing is based on guesswork. Investors can deal with a broker or choose contracts that include the opportunity to acquire futures contracts. Traders wager on how commodities prices will fluctuate when they believe they will rise. You would buy futures and sell them all when you believe the price will fall. You're committing to buy X amount of a particular commodity at a future date. For instance, you might contract to buy 10 tons of coffee 30 days after the trade is made. You're hoping there will be a substantial enough price difference by then for you to make a profit. One notable disadvantage for trading commodities is that margin requirements are much larger than for stocks. When you trade on margin, you're borrowing money, which might magnify your losses due to commodity price volatility. It's critical to have enough cash on hand to satisfy any margin calls, which occurs when your broker requests additional funds. The S&P 500 Index, Nikkei 225, Nasdaq, and DAX Performance Index are among the most popular futures exchanges. Number 4. Invest in commodity stocks. You can also invest in commodities through indirect means by purchasing stock in companies that produce commodities. You could, for example, invest in mining, oil, or agriculture stocks. Investing in British Petroleum allows you to get into oil business, while Rio Tinto allows you to go into the metals industry. The majority of the risks involved with commodities equities are related to the corporations themselves. Business operations or other company-related variables, rather than the actual value of the commodities, may have a detrimental impact on prices. This means that a commodities producer stock will not always rise or fall in conjunction with the commodity it produces. When crude oil prices soar, an oil production business benefits. But what matters more is how much oil it has in reserve and whether it has significant supply contracts with high-demand consumers. Unfortunately, there is no way to totally eliminate this risk, but investors can thoroughly research corporations before purchasing stocks. Number 5. Invest in mutual and index funds. Mutual and index funds are a useful entry point into commodities for new investors because they behave differently than other commodity investments. These funds have the same liquidity as stocks, but unlike mutual funds, they do not trade on an exchange. When you invest in commodity mutual funds, you are pooling your money with other investors. You are usually assisted by a professional fund manager. Take note that managed funds usually have higher fees. With a managed account, you can invest in a variety of commodities and sectors, allowing you quick diversification. Because mutual funds do not use an exchange, index funds track the price of a given commodity throughout the course of a trading day. They wait until the end of the day after the price has been settled to assess the commodity's value. By investing in these funds, you get the benefit of professional money management, additional diversification, and liquidity. This makes mutual and index funds an excellent choice for investors who want to profit from a commodity-related company without having to buy stocks directly. Number 6. Invest in commodity pools. Commodity pools are a mechanism for a group of investors to pool their money to buy futures contracts and options. If you have no prior experience investing in commodities, you need to engage with a commodity pool operator or CPO. These individuals pool money with various investors into a single fund, which they then invest in a commodity or commodity basket. Account statements and annual financial reports will be distributed to the investors. Your CPO will not only manage your fund, but will also keep track of who is investing, what they've invested in, and the pool's transactions. They may also make investing decisions depending on market movements. They can, for example, assist you in tracking commodity prices and determining which ones are ideal for your portfolio. Because they oversee a pool of investors, hiring a CPO also gives you more investment possibilities. They can put the pooled capital to better use, increasing the number of commodities they can trade. Okay, people, those are the 6 different methods you can invest in different commodities. While commodities are considered to be risky investment propositions due to uncertainties that are difficult, if not impossible to foresee, such as odd weather patterns, diseases, and natural man-made calamities, they are also known to be volatile. Commodities are best suited to investors with a significant amount of money to spare and at least some experience. Rather than putting all your eggs in one basket, manage risk by including commodities in a well-balanced portfolio. Commodity stocks, mutual funds, and exchange-traded funds are a superior long-term investment alternative for most people. Let us know what you think about commodity investing in the comments below. Thank you very much for taking the time to watch the video. If you found the video helpful, please give it a thumbs up and share it. Click on our channel for more interesting videos about personal financial investment. And don't forget to subscribe. See you in the next one!